This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to another episode of Value Investing. Over the last 3 episodes, we talked about Philip Fisher and his investment strategies. In episode 35 and 36, we talked about 15 points that Philip Fisher emphasizes when it comes to finding outstanding growth stocks. And in the last episode, episode 37, we talked about when is the right time to buy stocks once you identify outstanding growth stocks. And all of this one was based on Philip Fisher's investment strategy. And I was just reading a book called Common Stocks and Uncommon Profits. And all the contents that we discussed over the last 3 episodes and today's episode are in there. And I'm going to include the link in the show note to which you can go and buy the book from Amazon if you want. Even if you don't do that, don't worry about it because I'm going to cover a lot of details here on this podcast. So we talked about how to find outstanding stocks and we talked about when it's the right time to buy stocks. And in today's episode, what I'm going to do is we're going to talk about when is the right time to sell stocks. To me personally, this is the most difficult decision that I have to make because if I look at myself, it's relatively easy for me to find outstanding companies. I can just go through a list of companies that I understand and try to find out attributes that I'm looking for from those companies in order to identify outstanding companies. And when I just put them on my watch list and wait until price makes sense, for whatever reason, the price of the such stocks go down, then I look at them again and try to assess the intrinsic value and buy the stocks and put it in my portfolio if there's a large margin of safety. And in the last episode, Phil Fisher talked about when is the right time to buy stocks, and he had a little bit of different approach when it comes to buying stocks for his portfolio compared to Warren Buffett and compared to other value investors, but his approach also made sense to me. So what I'm going to do is I'm going to go over his strategies when it comes to selling stocks, and this is going to be very interesting. So before we get started, let me just give you a quick disclaimer that this podcast is for entertainment purposes only. It is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? So as I mentioned in the intro, what I'm going to do is I'm going to talk about the timing of selling stocks by Philip Fisher. And what I'm going to do is I'm going to go over 3 legitimate reasons for selling stocks by Philip Fisher. And also I'm going to discuss 3 bad reasons for selling stocks. So I'm going to go over in total 6 reasons for selling stocks. 3 of them are good and 3 of them are bad. Okay, so let's just go over them one by one. So why don't we go over 3 legitimate reasons for selling stocks? The first legitimate reason why you should sell your stock is because when a mistake has been made in the original purchase and it becomes increasingly clear that factual background of the particular company is less favorable than originally believed. This is the first legitimate reason why you might have to sell your stocks. I think this one makes perfect sense to me, but the most important thing here is the proper handling of your emotional self-control. So what I mean by that is a certain percentage of errors in purchasing are sure to occur in the future, right? Anybody can make a mistake. Unfortunately, long-range profits from really good common stocks should more than balance the losses from a normal percentage of such mistakes. So if you're making, let's say, good decisions for maybe 6 times out of 10 times, and you're making 4 bad decisions, over time, this 6 good decisions is gonna outweigh, the benefit of these 6 good decisions is gonna outweigh 4 bad decisions, and you're gonna be still fine, and you're gonna still have some money for your portfolio as a whole. But if you're making mistakes when this happens, losses should be far smaller than if the stock bought in error had been held for a long period of time, which is common sense. And what's even more important is that the funds tied up in the undesirable situation are freed up to be used for something else, which is better. But as I mentioned, the most important part here when it comes to identifying this mistake is how you can handle your emotion. There's always the ego in each of us. So none of us likes to admit to ourselves that we have been wrong. And this is the most dangerous thing. So let me just give you a couple of examples to provide you a little bit of color how professional investors handle such situations. So let's just talk about bad example, which is from Bill Ackman. So Bill Ackman invested a lot of money in a Valeant pharmaceutical company. I think this one was broadcast and covered by a lot of medias. So if you follow Wall Street Journal, if you follow general business events, you probably have known this event. So Bill Ackman is a very famous hedge fund investor who purchased huge stake in Valeant Pharmaceutical Company. And for the time being, his investment gain from Valeant Pharmaceutical Company has been spectacular. However, because of controversial business model, Valeant Pharmaceutical Company got into very big trouble. And the stock price has gone from, I think, above $220 down to approximately $90. And Bill Ackman didn't really back down when the scandal occurred. And he was defending his position on every single interview that he conducted. And he was trying to make sure that his position is not reduced because of this scandal. I mean, it could have been that the case that the scandal is just overblown by media, but he was not able to assess the situation in a logical manner. So Bill Ackman didn't sell any shares after this scandal broke out, and he just hold on to them because honestly, his position was almost got back to half of the value from the peak. And it was huge pain for his ego because Bill Ackman has been on TV a number of times in order to defend a Valeant position. So there's a lot of ego attached to his position there. And later, Valeant stock price had gone down from that $90 level to $20 level and even down to, I think, $8 level. And it went back to $20 level later. But Bill Ackman had to sell his shares when Valeant's shares went down to that low level. So this is a really good lesson. So the mistake that Bill Ackman made is that he didn't really assess the original purchase in an objective manner. And when the share price tanked, he was trying to protect his ego by not selling the shares and kind of incurred a lot of loss for his investors. And let's look at another investor and another example, which is a good one, Warren Buffett. So Warren Buffett made a huge investment in IBM. And this one was also well-known position by Warren Buffett. And for the time being, approximately 5 years, Warren Buffett had really praised IBM's management, IBM's business model, and he really defended why he purchased IBM. At that point, there's definitely ego involved because Warren Buffett mentioned this one, and he said that this is like one of the big 4 positions that he had, including American Express, Wells Fargo, Coca-Cola. And IBM is one of them. and he really loved the company. And he talked about it all the time during TV interviews, why he purchased IBM. And also, this is the first time he purchased technology company. But later, he sold every single share of IBM. So I think this is a really good example. And the reporter asked him why he sold IBM and purchased Apple. And Warren Buffett said that his original logic for purchasing IBM does not hold anymore. So he made a mistake in his original assessment, and that's why he sold IBM later on. So this is a really good example because his ego didn't get involved and didn't get in his way to sell IBM stocks. Also, another thing that I want to mention is that humans have a tendency to dislike a loss far more than a gain of the same magnitude. So first, you have to admit that you made a mistake. That's going to have some pain on your ego. And second, if you're at a loss, it's likely that you might just hold on to that position for long. So I think I've talked enough about the first reason why you should sell when you made the mistake in terms of your first original assessment of the company. So let's move on to the second legitimate reason. Over time, the company is no longer qualified for the 15 points discussed in the previous episodes. Usually this happens in one of the following reasons. The first one is a deterioration of management, and second one is the company no longer has the prospect of increasing the markets for its product in the way formerly did. So Philip Fisher here is saying that the company is no longer qualified for those 15 points, then you may have to sell your stocks from your portfolio. The first thing he mentioned is deterioration of management. This could happen for existing management because they can become complacent and face inertia in their operation. And this also could happen because of new management. So new management team does not measure up to the standard of the performance from previous management, then they may not perform as well as the previous management. So you have to keep an eye on how the management team changes over time. When this kind of thing happens, Philip Fisher said that you should sell the stock at once regardless of how good the general market may look or how big the capital gains tax may be. The second thing that Philip Fisher mentioned within this category is that the company no longer has the prospect of increasing the markets for its products in the way formerly did. As part of this, the management may explore opportunities in other fields, but they may not have any advantages in unrelated fields if they try to expand into unrelated areas just for the sake of growth, because they are under a lot of pressure from investors to grow their company. And if they explore new areas, they may not be able to as good as their specialty field. So this is something to keep an eye on. Another thing that Philip Fisher mentioned is that there is a good test as to whether companies no longer adequately qualify in regard to this matter of expected further growth. So he said that ask yourself whether at the next peak of the business cycle, the comparative earning per shares are expected to show at least as great an increase from present levels as the present levels show from the last known peak of general business activity. So this is kind of a little bit tricky to do that, but you can compare the current level of the earning per share and peak level earning per share and see if the company can achieve that earning per share in the future. You might have to do some basic math to do that. Okay, so that was the second reason. The second reason, let me just repeat that again. Over time, the company is no longer qualified for the 15 points discussed in the previous episode. Let's move on to the third legitimate reason, which is you find a better investment opportunity than you already own. I think this is quite common sense, and this is actually what I do. Because the ones that we discussed, the first two reasons that we discussed, I actually don't make any changes to my portfolio because I rather just put my stocks in my portfolio. Even if I see the changes in the company, I sometimes just keep them too long. And sometimes it actually brings me more capital gain or capital loss, but I tend to keep them in my portfolio. But for this third reason, if I find a better investment alternative opportunity, then I tend to sell my existing portfolio stocks and try to reallocate the capital. That's what I do. So this one makes perfect sense. So those are the three reasons, legitimate reasons why you should sell your stocks from your portfolio. The first one was the mistake has been made in your original purchase. Second one was the company is no longer qualified for 15 points that we already discussed in the last episodes. And the last one is you find a better investment opportunity than what you already own. So these are the three legitimate reasons. So now, why don't we discuss 3 bad reasons for selling stocks? And Philip Fisher said that you shouldn't actually sell stocks if you face these 3 bad reasons. The first one is you sell stocks based on macroeconomy forecast. And I think we discussed in detail about why you shouldn't follow macroeconomic forecasts. And it matters quite a lot, but it is just not possible to forecast the macroeconomic trends in the future. And also you have to write twice if you want to do the economic forecast. So what I mean by that is you have to know when to sell at the peak and you have to buy back shares when it goes down. But Philip Fisher said that he hasn't seen a lot of investors go back to their original position even after the market had gone down. So you have to be right twice. And he also said that if the company is a really right one, the next bull market should see the stock making a new peak well above those so far attained. So if you just keep the stock in your portfolio, then you're going to see a new high in the next bull market. But if you're trying to predict the bear market, first you have to know when to sell, like when is the right peak. And you have to know when is the new low from the bear market, because you might just wait, try to catch the bottom, but you might not be able to do that. So there's a lot of complications. So instead of just doing that, just keep them in your portfolio. And if the stock is the right one, it's going to reach the new high in the next bull market. The second bad reason for selling stocks is based on overpriced argument. That's what Philip Fisher said. You might argue that an outstanding stock has become overpriced and therefore should be sold. This is very logical in theory. If a stock is overpriced, why not sell rather than keep it? Let's take a step back and understand the definition of overpriced. People usually say that a stock is overpriced if the stock is selling at high multiples such as P/E ratio or price to book ratio compared to its competitors in the industry or compared to a historical ratio level. However, people wouldn't be able to know the earnings 2 years from now. They can't pinpoint how much the company is going to make 2 years from now. Even the company's top management wouldn't be able to know how much earnings the company is going to generate a few years from now. So what Philip Fisher is trying to emphasize here is that even if you see high PE, if the company is the growth company, if company's earnings grow quite significantly within 2 years, which nobody knows, then high PE ratio can be justified. That's why he said that you shouldn't use the overpriced argument for selling your stocks if the stock is an outstanding company. As value investors, we may not agree with this argument, but that's what Philip Fisher said. However, I think as value investors, we should do buy and hold strategy for the most part. And if so, then once in a while, you'll see very high PE multiples for certain positions that you have. But if you believe in the company's business model and future, then my recommendation also is not to sell the stocks even if you see high multiples. The third bad reason for selling stocks is because the stock price has risen in a huge amount, let's say over the last 2 years. Philip Fisher said that this is the most ridiculous reason to sell. Philip Fisher has seen a lot of people selling the stocks just because of huge advance in price, and they sell it and try to buy something that hasn't gone up yet. So he thinks that this is a ridiculous reason, and the outstanding companies don't work that way. So even if you have a huge stock advancement in terms of stock price, if this company is still growing and making a lot of earnings, there's a potential for the stock price to go up twice, 3 times. Who knows? It depends on the market the company is in. So he thinks that this is not really a legitimate reason for you to sell stocks from your portfolio. Okay, so I think I learned quite a lot from this chapter, and I hope that you'll learn quite a lot too. So today we talked about 3 legitimate reasons for selling stocks and 3 bad reasons for selling stocks. And let me just try to summarize what we have discussed so far. So the 3 legitimate reasons are: first, when a mistake has been made in the original purchase and original analysis, you might have to sell the stocks. Second, over time, the company is no longer qualified for the 15 points discussed, then you might have to sell the stock. Third legitimate reason is you find better investment opportunity somewhere else than what you already own. And 3 bad reasons: you're selling based on, first, market economy forecast; second, based on overpriced argument; and third, based on just stock price appreciation in the past. I hope you enjoyed this podcast. I feel this is a really good one. And just think about for yourself if these arguments make sense for you. And as I mentioned, Philip Fisher is a growth investor, so he might be a little bit different from value investors. So you have to pick the strategies that's right for you. I think that's it for today's episode. Before I end, I just want to remind you that please leave your reviews and comments, feedback, rating on this podcast, whichever platform you listen to this podcast. I highly appreciate your support, and thank you very much.